What credit card users need to know if the Fed cuts rates. Finally, the Federal Reserve looks poised to lower rate at its next FOMC meeting in September. Huge signs of relief from credit card users across the country plagued by rising debt balances. Through the current high rate environment, the target federal fund rate sits at about 5.25% to 5.50%, a more than 20-year high. The cost of their credit card debt has only grown. Look no further than this snapshot of federal rate data. Average credit card interest rate increased from around 16% in 2022 to over 21.5% today. Credit card debt balances grew by 5.8% between Q2 2023 and 2024. Total credit card debt surpasses $1 trillion for the first time in 2023. In the past year, 9.1% of credit card accounts became delinquent 30 or more days past due. But the Fed's decision alone may not offer the relief you're looking for. After all, plenty of factors influence your credit card's interest rate. Even if the Fed lowers federal interest rate, you shouldn't wait to begin paying down debt. What to do, or what do lower rates mean for your credit cards? Now, credit card interest rate could change when the Fed lowers rate. After all, many credit card APRs are variable and move over time. But don't count on lower interest rates from the Fed to make a very significant difference in your credit card interest charges. A single Fed rate cut is likely to only move the needle by 25 basis points. Even if some experts predict the Fed makes a 50 basis point cut, the Fed funds rate would only move by 0.50% to a target 4.75% to 5.00%. That's not likely to have much effect on credit cards sitting around near 25% or 30% APR. Consider, for example, the last time the Fed cut rates in February 2020 before two steep rate cuts at the start of the pandemic. The average credit card interest rate was 15.09%. By that May, when federal interest rates were near zero, average credit card rates only fell to 14.52%. They remained around there until rate hikes started again in early 2022. As of May 2024, the average is at 24.51%. So while credit card rates may dip a bit when federal rate cuts happen, the difference for cardholders can be really minimal. What's more, there's a growing gap between federal interest rates and the rate credit card companies charge, another factor that could keep your credit card APR high regardless of the Fed's decision. The APR margin between credit card interest rate and the prime rate based on the Fed's target rate has skyrocketed since the last time the Fed cut rates in 2020. Today, APR margins are at all-time high. What to do with the low rate? You can always find your current APR through your online account or on your monthly credit card statement. If it isn't automatically lowered, you may even ask your issuer for a lower APR. While there's no guarantee, you may have a better chance if you've improved your credit card score or increased your income since you apply for the card. Just remember, lower interest rates are not a reason to make all the minimum payments. You may see your required minimum payment decrease because a lower interest rate means fewer interest charges can accrue daily. But paying only that amount can leave you with mounting debt balances each month. Instead of waiting for relief from the Fed, you will be much better off taking action to clear your credit card debt now. Increase your payment. If you're only taking minimum or making minimum payment towards your credit card balances, now is the time to start putting as much as you can toward paying down your debt. Minimum payment can leave you with mounting debt balances for years and no end in sight. Even if you can only pay a few dollars more than the minimum each month, you'll start to chip away at the debt more quickly. Say, for example, you have a $5,000 balance on the card with a 21% APR. With minimum payment calculated as 1% of the balance plus accrued interest, it could take you more than crazy 25 years to pay the balance in full. If instead you could dedicate $200 towards the debt each month, you could pay it off in a much more manageable 37 months. Try implementing debt payoff strategies like the snowball or avalanche method, or just focus on making multiple monthly payments if it helps you to get ahead of your minimum. Don't add to existing balances. Now, it may be the most obvious move, but one of the toughest to implement. If you're working on paying down debt, try not to spend more on your card and increase your balances. You might forfeit some rewards value from the points and miles you would otherwise earn, but it can be a good idea to switch to a debit card or cash if you have a tendency to overspend using credit. Those rewards are not worth nearly as much as you would spend paying down interest charges and balances you can't afford. Consider non-profit credit counseling. If you're really struggling with long-term debt that never seems to go down, you may want to look into a credit counselor. A credit counselor can help you develop a realistic budget for spending, manage existing debt, or even develop a debt management plan. This can be especially useful if you don't have the great credit score required to take advantage of tools like 0% APR card. To get started, you can learn more about credit counseling through the Consumer Financial Protection Bureau, or look into nonprofit credit counseling organizations like the National Foundation for Credit Counseling or the Financial Counseling Association of America.